Let's build a Monte Carlo simulation in Python to help you see where the stock market price might go up. Firstly, what is Monte Carlo? Well, the Monte Carlo simulation runs the same situation thousands or millions of times with different factors affecting it to get a range of outputs instead of a single answer. Everything except for those random inputs stays fixed. In our case, we'll be simulating the possible trajectories of a 5-stock portfolio 5,000 different times. And today we'll be utilizing geometric Brownian motion, which is the price model we use inside each simulated run. Now let's get coding. After installing our libraries, we need to pick the 5 tickers that will go into our portfolio. Today I'm using Apple, Microsoft, Nvidia, Amazon, and Google. We get their recent price history from the Y Finance library, so we're starting with the real data. After cleaning up the data a little bit, we use that price history to compute the daily returns and take the latest closing prices as our starting price vector in the simulation. This is our anchor, the place that every simulated future will start from, and as you'll see in our code, this is called S sub 0. Next, we choose how far ahead into the future we want to look and how finely to break up that time. In this example, we're simulating 1 year, denoted by the t equals 1, and splitting it up into 252 training days, which you can also see below. Then we let the model know that we're running the simulation 5,000 times, which is what the paths variable means. And the last seed is just the random number generator seed. It's just a starting number to make sure that the draws are reproducible. Now, using the price history, we estimate 2 things for each stock. First is an expected annual return, which is the steady average push you might expect. Second is an annual volatility, which measures how big the day-to-day variance tends to be. We also measure how each pair of stocks moves together, which gives us a correlation structure. We combine the volatilities into a single covariance, denoted by the sigma variable, to measure how wild each stock is and how they move together in realistic ways. Now it's time to create the random movement in the simulation. First, we draw random numbers for every day, every stock, and every simulated future. This is a complicated concept, but think of it like this. Imagine these draws as a lot of dice rolls, but instead of giving every stock its own independent die, we create a small shared set of base dice. Then we give each stock a short recipe that says something like use 30% of die A, 50% of die B, and 20% of die C. By the way, using 20% of a die just means multiplying that die's output by 0.2. On each day, we roll these base dice, and each stock's daily shock is the weighted sum of these base rolls. So if a base dice shows a big number that day, every stock that uses that die in its recipe will move together. And because the recipes are chosen from the covariance table, which we talked about before, the end result is daily shocks that have the same variances and pairwise relationships as the historical data. Now, on each day, a stock price's future is determined by 2 features. First is a small deterministic push based on a stock's overall expected return, and second is a small wiggle or shift based on that stock's volatility and how big each day is. We add that steady push and the correlated wiggle to get that one daily change for the stock. Then we stack those tiny daily changes day after day to build full futures. To form a portfolio, we create weights for each stock. So for an equal weighted portfolio, we'd want each ticker to have a weight of 20%. We multiply each simulated stock price by its weight, sum this across the 5 tickers in the portfolio, and do this for every day and every path. That gives us our 1 portfolio value per day for each simulated future, and this is what really matters. At the final day, we collect the portfolio value from every simulated future and read off the summary statistics. The middle value is the median, or the typical case, the 5th percentile is a rough bad case, and the 95th percentile is a strong upside case. Those 3 numbers give us a typical outcome and realistic upside and downside ranges based on the inputs that we put in. Finally, here's the code for a quick visualization. Each blue line is 1 simulated future showing how the total portfolio value would evolve day by day for 1 random draw of shocks. You started all of the possible futures at the same spot, which is the black dashed line, and each path shows a different possible world under the same assumptions. The cloud shape tells us 2 things at once, central tendency and uncertainty. Near day 0, the lines are pretty tight because there's not much time for randomness to accumulate. But as time passes, those paths fan out. That's the volatility showing up, and a larger standard deviation means a wider fan. The upper lines are the upside tail, which are the rare but big gains, and the lower lines are the downside outcomes or the loss scenarios. And now we have an idea of how our 5-stock portfolio would act under certain conditions. And that is Monte Carlo for you in its simplest form. If you learned something from this video, don't forget to save it for the next time you're working with Monte Carlo and follow for more.